First, let me give you a summary of the risk classifications to better guide you in choosing the right fund option for your investment. I categorize the risk classifications into very low, low, moderate, and aggressive. For time horizon, let's say we would consider short term if your time horizon is 1 to 3 years. Medium term, 4 to 7. Medium to long term, about 8 to 10 years. And long term would be above 10 years. Now, let's move on to the investment objective. Okay. So first, what does preserve capital mean? In order to explain it, let me compare to you investing in a bank versus investing in mutual funds. Okay. When you put your money in the bank, let's say you deposited 10,000 pesos today, you can be sure that after a day, after a week, after a month, after a year, or 10 years after, your 10,000 is still 10,000 with a little interest with it. Okay. So investing in a bank, putting your money in a bank, the risk is very low. So it means you preserve your capital if you place it in a low risk investment type like a bond, like a bank. Okay. While as in mutual funds, there is risk involved. If you invest your 10,000 today, its value will be different tomorrow. In fact, it changes every day. Okay. There are ups and downs in the value of your investment depending on the market factors that affects the investments. So let's say, for example, your investment objective is to preserve your capital, meaning you don't want to sustain losses with your investment. So it is best to put it in a type of investment with low risk like a bank or other types similar to a bank, similar to a low risk classification like a bank is, because you don't want to lose a portion of the value of your money at any given time. Okay, so that is what you mean with preserving your capital. Okay, you don't want its value to move, especially to sustain a loss. Okay, let's move on to the investment objective of preserving capital and earn some income. Okay, take note, like a bank, the interest being earned by your money is very low. Right now, a savings account would only give you 0.25% in a year. Okay? 0.25 means your money is earning, let's say you deposited 10,000. So your 10,000 will earn 25 pesos for 1 year. So in investments, there are trade-offs. If you're not willing to risk your money, then you can only expect a low return on it, and vice versa. So this is an example. You want a low risk, then you can only expect to earn 25 pesos with your 10,000 in 1 year. What if your objective is you want to preserve your capital, but you also want to earn some income in a way? Okay? You want to earn more than 20, you want your 10,000 to earn more than 25 pesos in a year. Okay, so if that's the case, meaning at this point, you're willing to risk a little more, okay, than the first objective. So that is why this is ideal for those who are willing to take a little risk, okay, or low risk. Okay, so that is what this investment objective means. Okay, you still want it to be some kind of a low risk, but something that will give you a little higher income than this previous option can provide you. Okay, so let's move on to the next. For the next investment objective, you want to earn income and grow your capital. Let's, in investments, when we refer to the word income, we usually mean it's a fixed interest, just like a loan provides. For example, you loaned money from a bank for a certain purpose. So the bank is earning a fixed interest from you. Okay, so that is what we refer usually with the word or the term income. It refers to a fixed interest, meaning your money is invested in an interest earning security like a bond fund. Now, if you remember, I mentioned in the investing in mutual funds guide that investing in bonds is like lending money. Okay. And in return, the issuing party will be paying you interest for your money. Okay. For the term of the bond. Whereas in investments, when we say capital or growth, okay, we refer to your principal money, meaning the money you invested, as growing or appreciating in value, meaning it increases in value. Similar to a business owner who established a business and earn income from the business that he put up. Because when you say you grow your capital, you can achieve that if you invest your money in equities, or meaning, in other words, you are also investing in businesses. And your money will grow or appreciate if the businesses that you invested into become successful or earn return from their respective investments or capital that they put in that business venture. Okay, so meaning this investment objective, to achieve this, you would be investing in both bonds or fixed income securities and equities, where mainly you will be invested in businesses or companies. For the last investment objective, your goal is to maximize return, meaning your risk appetite is very aggressive. You are willing to take risks for your money. Okay, so in this case, the ideal fund option for you are high risk investments, which is equities. Again, we already discussed in the investing in mutual fund guide why investing in equities is considered high risk. All right. Again, so why do investing in equities would potentially provide the highest return? Because the amount of money that you can earn in doing this does not have any limit. Okay? As long as the companies you invested to are performing well, okay, and that is the main purpose of businesses, then you can expect that the money you invested in their companies would also appreciate like the businesses you invested in. Now, let me show you the relationship between the risk and the returns that types of investments could give you. Remember the general rule in investments, which is the higher the risk, the higher the potential return you can earn. Okay, so with that general rule, the very low risk fund option also gave you a low return compared to the other options. Okay? So in these returns are the best returns that this fund, the fund options per risk classification has provided since the inception of the fund. Again, I took these numbers from our historical best. This is the best returns that our respective funds has earned since the fund has started. Okay. So originally I plan to use 1 year returns, but because of different market factors, a short-term return would not give you the right picture. Okay, so that's why I decided to use the best historical returns, because this is taken from a long-term point of view. All right. Okay. So both the low risk classifications gave the lowest returns among all the options. Okay. While the moderate risk classification funds gave also the average return among all the options. And the most aggressive fund options gave the highest, best historical return of 69%. Okay. Again, based on the long-term data, the general rule, the higher the risk, the higher return, and vice versa, prevails. Okay. Our actual returns shows just that. So these are our moderate risk fund options. So we have two options here, the balanced fund and the achiever funds. The balanced fund is a mix of bonds and equities. For the year 2021, it earned 4.49% for the year, but its 10-year return is 31.89%. Now, in other words, if you invested 100,000 in balanced fund 10 years before, then it is now 131,000. The next option is achiever fund. So it's also a mix of bond and equities. The only difference with the balanced fund is that it has maturity dates. So what's the difference, or what's the significance of a fund having a maturity date? Well, it's designed for investors saving for a specific purpose. Let's say, for example, you have a child entering college in 10 years' time. So you can opt to invest in an achiever fund maturing in 10 years' time. Okay. So what's the importance of investing in a fund with a target date? For example, it's 2022 right now, and your eldest child will be in college in 2032. Okay. So if you invested that in a balanced fund without maturity date, then the money will just be in balanced fund even at the time you are going to redeem it, unless you manually switch it to another fund. Okay. If you remember the basic concepts in investments, we invest for a specific purpose. So depending on your time horizon, the ideal investment or fund option for you would differ. Okay, so ideally, if you're going to need the money soon, it is better that it is placed in a conservative fund or in a low risk fund, so that it will not be much affected by fluctuations in the market. Okay, so again, if you put your money and you intend to redeem it in 10 years time, if you put it in balance fund, then it will still be in balance fund until you switch it to another fund. Okay, but in achiever funds, for example, you chose to invest in an achiever fund maturing in 10 years time or in 2032, you invested it For example, you invested 100,000 this year, and you will be needing it after 10 years. If you place it in Achiever Fund, 5 years before 2032, by 2027 or 5 years before maturity date, the fund manager will transfer it, for example, in a bond fund. Okay, so from balance or from the Achiever Fund, it will be transferred to a bond fund. No, the reason behind it is that it will not be affected by volatility because we know that you will be redeeming it by 2032 or 5 years from the transfer date. So we would want to safeguard or to ensure the value of your money, especially if it has gained already. Let's have another example to illustrate its significance, okay, of a maturity date. So for example, scenario A, you invested in balanced fund, okay, 100,000 today, and then you intend to redeem it in 2032. But since you put it in balanced fund, it's still in balanced fund, and you did not switch it, okay? Come 2027, 5 years before, the value, for example, is already at 120. So you have a 20,000 gain. And again, you did not switch. Okay, so come the time that you're going to redeem it, after 10 years from the date of investment, the value slightly went lower to 118. So from 120, it became 118 because it's still in balance fund, a moderate risk fund. Okay, but it's just a small loss in value, no, and you still gained 18,000 from your principal, no, it's still good. No, but what we're pointing out in a target fund option is that for like in scenario B, you invested 100,000 today, again it became 120,000 by 2027, and then since it is in a target date fund, the fund manager will transfer your fund to a more conservative fund option before the maturity date. Let's say it's 5 years before the target date. Okay, so 120,000 was transferred, for example, to bond fund. Okay, so come maturity date of 2032, though it did not gain as much because bond fund is a low risk and low return fund, but it still gained 1,000 pesos compared to the time you transferred it. Okay, I mean comparing 2032 to 2027. Okay, so that's the beauty of a fund with a target date. Well, that's the only difference, but the mix of investment are just the same. They both have bond and equities. So as of 2021, as of today, we have 3 achiever funds. So the return was around -4% to 2%. Okay. And the fund is fairly new. It's just about 2 years old, I think, as of now. So we don't have a 10-year return for that. But to give you a longer historical performance, we have similar funds in our life insurance, in our VUL funds. Okay, so far, the target date funds like this one, or we call it future funds in VUL, they are the best performing fund options in VUL. It even exceeded the performance of equity funds. Why it has exceeded the aggressive funds in terms of performance? Based from one of the fund updates of our fund managers before, he mentioned that one of the strategy of achiever funds is that they have a ceiling and a floor, meaning they buy at a certain price or a certain level, and they sell at a certain price or level. So I think that strategy works well for the funds. But anyway, based from our experience in the VUL funds, again, this is our best performing fund so far for quite a few years already. So this is a good option if you're after higher returns. Anyway, you can mix different fund options together. So that's why the reason I'm sending you this video, because your risk profile is apt for a moderate risk fund. You're a moderate risk type of investor, no? So you can either choose one, like you can choose to invest everything in balanced fund, 100% in balance, or 100% in achiever, or you can also do 50-50. Okay? Since your risk profile is moderate risk, you can also add the low risk funds to your portfolio. Meaning you can also do like, let's say you want to invest 25% in balance, 50% in achiever, and the remaining you can invest in bond fund. It's up to you. So you are allowed to invest in low to moderate type of funds. Okay, so if you have questions as of this point, you can just message me, or I'll just explain it further to you or clarify whatever it is that you need clarification on. All right. Thank you. Bye.